Hello and welcome to the Risk in 2020 and Beyond Executive Panel Discussion, part of the Risk Hong Kong virtual conference. My name is Blake Evans-Pritchard and I'm the Bureau Chief at Risk, the Asia Bureau Chief of Risk.net. With me, I have a group of industry experts that are able to provide informed insight into some of the risk management challenges that industry is facing today. I'd like to keep this discussion as lively and interactive as possible. I'd therefore encourage you to submit questions live to our speakers throughout the session, which I'll be picking up as we go. This can be done via the Q&A function on your screen. Please note that any questions that we do not have time to address live, we will pass on to the speakers. So, with housekeeping out of the way, let us kick things off. Today, we'll be in discussion with Darren Kim, who is the Regional Chief Risk Officer and Regional Chief Credit Officer for Greater China and North Asia at Standard Chartered Bank, Nick Anzman, Chief Risk Officer for Hong Kong and Global Head of Risk Transaction Banking at ANZ, and Lewis Kuijs, Head of Asia Economics, Oxford Economics. So thanks to all for joining us today. Our risk obviously is very much on everyone's minds at the moment, from dealing with the impact of COVID-19 to the geopolitical uncertainty brought about by US-China trade tensions. It is certainly an interesting time to be a risk manager. So let's turn to our panelists to see what they think of the core dangers out there and how they go about identifying and assessing them. So Darren, maybe I can turn to you first on this. I mean, there's obviously a lot to think about at the moment in terms of risk management. What are the key dangers, the key risks that you think about and drive the stuff that you do? Sorry, Darren, you need to switch on your microphone.
Sorry about that. Blake, thank you. Reflect on a few things actually before I go on sort of the key issues that we face today. I mean, if you look back in 2017, we had to deal with the geopolitical risk between North and South Korea, and then shortly after we had the US-China tensions started flare up, and then last year we had to deal with the Hong Kong social unrest, and then now we have a COVID-19. So it's almost a triple whammy or quadruple whammy. So it's been a series of unfortunate incidents or the developments that we had to deal with, and it's been a pretty tough environment to be on top of everything. So I mean, if you think about risk management is not really known to be flexible and agile and super adaptive. So that's kind of traditional risk management. But last 2 or 3 years, look back, that certainly had to change, right? Because ever-changing dynamics, whether it's a sanction, whether it's a trade-related, we had to deal with a lot of the incidents that comes up, and we had to change the way we operate and underwrite some of the clients. So just giving you a couple of the examples that we have done, what we are doing currently to manage the sort of triple whammy. On the retail front, what we see is actually increased the fraudulent activities. And this is not just happening in Hong Kong because there's a lot of government relief programs out there. There's a lot of fraudulent activities, loans to SME. There's a lot of fraud around the credit cards, personal loans. So there is definitely a increased fraudulent activities in Hong Kong, but we also see that other parts of the world, including the US and UK. So what we are doing actually, we've added additional measures to mitigate the fraudulent activities. So that's something that we had to implement as a part of the COVID-19 and people working from home to prevent that and catch the fraudulent activities early on. The second thing is on the wholesale front. Obviously, we had to change the way we onboard clients on the wholesale front, especially clients that in Hong Kong and China. is largely due to sanction risk, U.S. sanction risk. So we have scrubbed all the clients in our book and which clients are vulnerable to sanction risk, and we have taken some actions on that. And on top of that, with the new clients, one more underwriting piece that we see, we assess is obviously sanction risk and vulnerability of the client to the sanction risk. So in particular to tech sector in China, we have slowed down onboarding some of those sensitive names. And to make that decision, we have introduced a couple of things for the retail bank as well as the wholesale bank. In particular, the wholesale bank, we have introduced a new AI technology called the credit decisioning engine. So we've been building, as you know, the AI and big data is used quite a bit on the retail bank side, and obviously they're a little bit ahead of the game compared to the wholesale side. So we've been working with one of the developers out of the US last couple of years. And despite the COVID-19, we launched this tool where basically this AI we've been actually feeding a lot of the information, the credit application that we approved and also the credit application we have declined. So that the machine's been taking or learning all these applications last couple of years, so it has a history. And basically, it does give you some of the key decision making the components, and then approvers can compare in how they drive to the decision and compare to the machine. And if there's a difference, so let's say the machine says no, we should not approve this credit application, and then approver saying that we should approve it. And obviously, approvers wins. This is the machine still in development, and we are calibrating the machine. So then, when there's a difference of opinions between the approver and the machine, we feed that information to machine so the machine can learn. So despite all the challenges, we launched the CDE this year. On the retail side, as some of you know, we have actually launched a all digital bank in Hong Kong last month. So we have a pretty good traction. So we actually built that up ground up from scratch. It has nothing to do with the mothership bank, the commercial bank here. So last 2 years, I think we have done a tremendous work around technology, digitization on the retail bank, but also on the wholesale side, the AI. So deal with all the risk and the horizon risk.
Okay, thanks for that introductory overview. So Nick, turn to you now. Have you had to adapt over the past few years, how you're seeing risk and approaching risk? What do you see as the core dangers, core risk, core issues out there?
Yeah, I mean, I agree with a lot with what Darren had called out. I think the other thing that I would add is what I kind of refer to as asymmetric risk, and that as an emerging risk area for the banking sector. So what I mean by that is historically, over the last 20 years, we've had an economy globally that's been pushing to become more integrated and to remove barriers of trade. And banks have helped facilitate trading capital flows in that environment. Over the last few years, obviously with the rise of nationalism and other disruptions, we're now seeing those barriers be reinstituted, and that's causing that asymmetrical risk for the bank. So in addition to being a CRO for Hong Kong, I'm also the risk executive for the global transaction banking business that looks across 30 plus countries about our TB trade flows, our PCM flows. And I can tell you that there are emerging risks such as, the ability to get unconditional guarantees called is not as unconditional as it used to be. So that's something that we are now attuned to about what are these national or political barriers that are coming that might put the banks in the middle of a transaction where we can no longer price or take that risk appropriately. Again, banks have been built to take primarily credit risk, market risk, liquidity risk, and we have models, we have capital, we price for that. But when you start talking about the ability for us to be caught into a sanctions risk environment, a commercial dispute between a national champion, let's say technology companies, that's a risk that the bank is not able to take or willing to take. And I think we're now having to have those difficult conversations with our customers to say, this is not what our purpose is as a bank to take this risk. And we need to understand, get deeper insight between those relationships of our customers and those offshore cross-border transactions, and how we can ensure that that risk is mitigated or the customer understands that that's a risk that they need to take going forward. So I'd say those are probably the key asymmetric risks that I call out in the current environment that we're dealing with.
Okay, thanks, Nick. And Lewis, obviously you're not working for one of these banks. You're sitting outside of that, but maybe you can sort of share some thoughts on how you see the risk, how you've seen the risk environment developing recently.
Yes. So as you say, Blake, we are not risk managers ourselves, but for us, risk is a big part of our work in the sense that we are forecasters, and so we have models, and we write about our forecast, and we have databases that include our forecast. And we always need to talk about our best guess estimate of where the future may evolve to. But there is, of course, always a distribution of risks around that. And I think one of the difficulties, it goes back a little bit to what Nick was talking about how the extraordinary events of the last 15 years have also led to risks becoming asymmetric, in the sense that people may have read it a lot and heard a lot about it, that risks are skewed to the downside, which traditionally was not something that people were used to, because traditionally 20 years ago, if I would go to my boss and say the risks around my forecast are skewed to the downside, then he would say, well, in that case, you need to adjust your baseline forecast. But I think what we have moved towards is, because of QE, because of deglobalization pressures, there are now a whole range of possible scenarios, sometimes with fairly small probability, but they do exist, that mean that in technical terms, that the mean of our risk of our probability distribution is lower than the mode. And we talk about the mode, like that is our baseline forecast. So it sounds very technical, but it has major implications. It basically means that we are already quite bearish as to how rapidly the global economy will continue to recover after the third quarter. We saw a very nice bounce back in the third quarter, when many economies basically started to open up a bit after having been largely closed in the second quarter. So a wonderful V shape, but unfortunately the V shape has ended, and from the fourth quarter onwards, it's going to be much harder for the global economy to continue to recover. And in addition to that, we have that issue that the risks are skewed to the downside. So there's a whole range of likely or of possible scenarios that could mean that that global output next year will not be only 2% lower than where we had expected it to be before COVID hit, but it could be something like 8% lower if one of those fairly low risk probabilities, for instance, because of the US-China trade war or because of COVID, if one of those very low risk probabilities materializes. And there is a key here. The key is that macroeconomic policy, especially on the monetary side, does not have the room to really respond to further major downside risk. And that is why these downside risks are so prominent. And so I would say there have been developments in the last 20 years, which are changing the way that we as economists need to work with risks and how we can help our clients.
Okay, thanks for that. Thanks everyone for the introductory thoughts. It's sort of, now we can sort of go back to each of you, and so maybe we sort of dive into a bit more depth into some of the things that you were highlighting. So I mean, Darren, maybe going to you first. I mean, it was very interesting what you were talking about in terms of onboarding clients and some of the things. some of the things you need to think about these days in terms of assessing their risk and the new system that you've developed and kind of rolled out. I mean, do you think that is becoming kind of like sort of more important now to do that than it was in the past? I mean, obviously banks have always looked at the risks that they face by the counterparties they deal with, but now you've got trade sanctions from the US and things like that. Is it becoming more important in this part of the world?
Yeah, absolutely, Blake. I think one has to be more holistic, right? So traditional risk managers have what's called the intuition, right? From your experience, looking at different clients and looking at different trades, deals, and whatnot. But these days, obviously, you still need to use your intuition, right, from your experience. But also, I think we're moving very fast to data analytics. So your decision based on accurate data and big data, and so if you can get the information as much as possible on particular client or transactions, I think the better decision that you can make, and you can make the decision much quicker. So a lot of the tools that we're developing here is really to aid approvers, not to replace risk professionals for the time being. It may be will be distinct, but for the time being, it's really about aiding our decision making, allowing to collect all the data more efficiently, but more importantly, accurate data, and how you interpret that. So if you have an AI machine or an analytics tool to help you to get to that decision point, you're going to make a better and quicker decision. So this is what we've been focusing, and I think not so much about COVID-19, but because of the series of the events that I just mentioned, U.S., China, there's a different elements that we must consider when we're doing risk management. So one has to look at the sort of a holistic view of the geopolitical tension, but that's really sort of the overlaying risk. But if you actually get down to the customer level, under COVID-19, as an example, you're not going to be able to see face-to-face, do your KYC and due diligence face-to-face. I have done some last few months, but very limited compared to before. So I think you pick up a lot of soft the information, not just the financial side of the client. That's you can get it easily, right? But the non-financial aspect, the management, the integrity, and whatnot, those actually is harder to get. Now you do it online, but it's never the same as when you have the face-to-face interaction. So I think only way you could actually sort of supplement that is really having strong the data analytics, the data behind, and this has been our core focus last few years, to have a data that is relevant to make your decisions, and whether it's on the wholesale side or on the retail side. And this is where we're spending the money and resource and the people. And as I mentioned, a couple of the tools that we rolled out this year are helping to achieve that. And if we look at the bank industry as a whole this year, I do think we need to pat our shoulders a little bit. We have done well. I mean, despite the super high, the easier charges, stage 1 and 2, I haven't seen any banks would really get bombarded with the stage 3, right? The individual impairments. So I do think we've been handling it very well. But the longer that we actually forced to work from home, I think the non-financial risk is actually rising, right? So far, none of the banks that I see in Hong Kong or across the globe, but avoid any major operational losses. But longer we stay and longer we're forced to work from home, I think that the vulnerability or the operational risk is getting much higher. So I do see some signs of that stress, operational non-financial risk rising, but it's not to the point where I should be really concerned. But this is something that we're watching as well, right?
Sure. So
I'll
I mean,
stop
just
there.
yeah, sure. No, just very quickly on that. So I guess you know, analytics and sort of data analytics and tools are potentially becoming more important then, because you're missing that face-to-face interaction that perhaps you're not getting the information in that assessment that you would have done in the past. And so is there more of a focus on analytical tools?
Yeah, absolutely, absolutely. So this is, I mean, obviously we've been working on these analytical tools for many years, and so it happens that COVID-19 happens, and it's really you see the benefit of those analytic tools. So we are going very digital, and even especially in Hong Kong, I have to say, Hong Kong as a market, it's been a little bit slow to adoption of the new technology. I mean, if you look at in Hong Kong taxi, I mean, they're still insisting on cash and whatnot. So, but with this COVID-19, I think what's happening, we see the shift of especially the elder generations adapting to the online or digitalization, digital. So that's actually a very good development because we launched the digital bank last month, and we see quite elderly generation sign up last few weeks. So I do think the COVID-19 is accelerating the Hong Kong to adopt the new technology or digitalization for sure.
So okay, thanks. So sorry, Darren, there was a bit of interruption with your sound there, but I think I got the point. So Nick, maybe I'll sort of turn to you quickly now, because I mean again you're sort of making a very interesting point about asymmetric risk and that being on the rise and needing to deal with that. But I mean, asymmetric risk has been talked about for a good few years. I mean, is it getting is asymmetrical risk increasing more? I mean, are people starting to look at this more as a risk they need to deal with? I mean, is asymmetrical risk management properly understood, or are people still exploring that?
Look, I think the concept itself at a high level, people understand when you're talking about non-credit losses and the banks being exposed, and obviously banks have been exposed to that for quite some time. But I think right now with the ever-changing disruptive political and nationalistic environment, that risk has absolutely increased. I mean, if we were talking about sanctions risk, 3, 4, 5 years ago, we were talking about maybe a bit of Iran, and every bank in the world had already been well informed and had contained any involvement to Iran, years ago, right? But now you're talking about major economies that have had, very integrated trading relationships, having political infighting, and that's now causing a major disruption to the banking sector because we're the ones facilitating a lot of that trading capital movement and those flows. So, yes, the concept has been around, but I think the awareness or understanding has absolutely increased, but we need to do a lot more as an industry to build the competency around how we understand the trading relationships and the interdependencies across the supply chains. Certainly that's the conversations we're having internally within ANZ, is looking more holistically at supply chain relationships on the institutional side and understanding if there is a decoupling or if a piece of that supply chain, let's say in China or in the US, were to be affected or disrupted by sanctions or other type of barriers. How would our customers respond? Do they have alternate means to channel that sort of supply? Do they have alternative markets that they can sell into? How can the bank be ahead of the game and make sure that we are not stuck with that sort of exposure at the point in time when the sanctions become activated? And I think that's the other challenge, is that we see every week there is a different announcement. Some of the announcements are just sensational headlines, and we have to try to, as a banking sector, decipher what that means. Is that an actual real and present risk today to our relationships? There are, of course, concrete actions that have been taken with new names added to sanction lists or names put onto BIS lists. And the question for the banking sector is that, do we have the awareness or the understanding to assess what these various levels of sanctions mean to the activity we get involved in? You know, if a name is on a product sanction list, does that mean that we should step away from the relationship altogether, even though our transactions technically are not in violation of the sanctions? But as a bank, I think we are all taking risk-based approaches. And certainly sanctions risk is no bank in the world wants to be caught out on a sanction. So I'd have to say that most banks are acting in a very conservative manner, which goes to Darren's point about onboarding, that if there is any whiff or any degree of sanctions exposure by onboarding a customer or continuing a relationship, most banks will act pretty swiftly to mitigate that exposure, which means effectively winding it down and exiting the relationship. So I think that's the sort of various degrees of assessment that we have to now understand with internally, and what sort of models and frameworks we deploy around that. And we have to act quite quickly and adapt to these changing environments, which is something, again, as a big sector, you know, that's quite difficult to do, especially with relationships that may go back several decades.
Okay. Thanks for that. And Lewis, turning to you quickly, because you were talking about macroeconomic scenario modeling and how they were being developed. You know, how useful are these models in the current environment? I mean, you know, there's a lot of uncertainty at the moment that's being brought about by COVID. So you've got all these sort of models out there. Are they becoming more complex? Are they having to, you know, adapt the way that this scenario modeling is being done?
Yeah, I think the models themselves, the models that we use, don't really change. And the methodology, I would say, around that risk scenario work is also not really changing. But there are things that are new on the horizon, I would say. I think, for instance, with COVID-19, the big problem is that none of us are virologists. None of us really have a good grab on that health and virus dimension, and that means that we have to be a little bit modest and only focus on the economic implications of it. But it is something that is an issue. The fact that we are, you know, when it used to be that most of the big risks that we were thinking about and that we were working through with our clients in terms of, you know, how does a banking crisis affect the economic environment, even geopolitics. We're quite used to you know, running through geopolitical risk scenarios through our macroeconomic models. But COVID-19 is a different kettle. It's new, and I think there is another new development, another new risk that we have a harder time with dealing because we are not experts, and that is climate change. We are working at the moment on doing, you know, longer-term risk scenario work and also incorporated it in our forecast. But, you know, just as we are not virologists, we're also not climate change experts, and it is, I can tell you, it's not trivial to actually decide, you know, where as an economist you are comfortable threading and talking about, and where do you need to say, okay, this we'll just take from the experts.
Okay, thanks. So just sort of remind everyone in the audience that do feel free to send in questions, and I will put them to the panelists as they come in. But kind of moving on, we're going to sort of, moving on to talking a little bit. I guess we have talked a little bit about sort of COVID-19. And you know how that has factored into risk management here, but there seem to be so many risks, you know, out there in terms of sort of US trade tensions and things like that. I'm just wondering, in terms of sort of COVID-19 over the past like sort of 4 or 5 months, we've had COVID-19, and people have had to work from home and adjusting to working from home. I mean, Darren actually did talk a little bit about this and what he was saying about some of the sort of challenges, you know, challenges that brought about. But maybe I can ask you, Nick, for whether you've seen any sort of specific challenges, specific issues that have come about from this whole COVID-19 reality and the need that everyone has to work from home?
Yeah, I think as Darren said, the biggest area of risk that has been enhanced because of, or is increased because of COVID-19 has been around the operational risk control environment. So quickly, when we had offices that had to move, from 100% of the office to quickly to maybe a skeleton staff of 10% in Hong Kong in the office, as a management team, we quickly have to bind together and figure out, well, what are the critical tasks and the critical functions that we have to ensure continue. Now, within our bank, we've instituted for several years now an operational risk framework where we identify what are the key risks facing the business, and then each risk would have a flow-on level of key controls. And then from there on, key risk indicators to determine whether the controls were operating effectively or not. So when COVID was at its height here in Hong Kong, and we were one of the first cities to go through it, it was very quickly getting together to say, okay, what are the KRIs telling us? Are there any that are flashing red where we're having a control failure? Any sort of manual processing that is required to do in the office that involves actual paperwork? How do we prioritize those functions to make sure they stay intact? And if we cannot, for any reason, perform those up to the standard we need and the competence we need, what is that impact to the business? Do we need to talk to certain customers about ceasing certain activity? How would that play out? Luckily, we didn't have to go to that degree, but this is the sort of planning you have to conduct, in that sort of environment from a work from home. So I think it was a really good lesson for all of us, a surprising lesson, I'd probably say, for most of the entire industry about how effectively we can continue to manage banks from a work from home environment. We're an Australian bank, and Melbourne is still in a very shut down situation, and the bank has continued to run really well. Part of that's because of a move to digitization for a lot of customers, as Darren had said. And I think later on, I think we'll probably talk about what that exposes to from a technology risk perspective as well. So I'll hold off on that. The last thing I'd say, following actually on Lewis's point about the modeling, is that, people are saying COVID was a 1 in 100 year event, right? So it's almost should be modeled or baked into our expectations that we would have an economic situation or in a situation such as an outbreak such as this. And it's great because conceptually, as a risk manager, when you talk about models and you tell people, oh, this is a 1 in 100 year event, I think if we were to say something like this a couple of years ago, we'd all be pretty comfortable taking the risk. If we said there was a 1 in 100 chance of this company having a real issue if a pandemic broke out, we'd all probably say, okay, that's not likely. And then of course, when the 1 in 100 event does eventualize, that's a real problem. So I think it's, for the banking sector, it's caused us to stand back a little bit to say, what are the tail risks? What are the 1 in 100 year events? And do our customers and do the banks have the capacity to absorb those events and have the flexibility built in and the scalability to adapt to those environments? So, I'd say that was a really important lesson through COVID.
Sure. Okay, thanks. And it feels though we can't have any discussion about COVID without turning to sort of technology aspect. And that seems to sort of change and evolved in all different organizations as people have had to get used to the new reality. And Darren, you were sort of talking quite a lot about sort of technology when it came to sort of onboarding clients and the AI systems that you're using. I wanted to go to you perhaps on this and ask, has COVID-19 really affected the way that you use technology and sort of look at technology in the risk management function, or the things you've been developing would have been developed anyway?
Yeah, let me take that slightly differently. Obviously, with the COVID-19, most of us have been working from home. So what we actually realized, noticed the last few months, obviously, if you look at this, I won't go into the technical aspect, but the broadly speaking, holistically, I think there needs to be more connected data and analytics sharing between different functions, as an example. So for example, risk, CFCC, compliance, and financial crime, and even finance. We tend to have a sort of use the data for different purposes. And what I find, because a lot of people are working from home and they're not as connected as before, and without face-to-face in the office, I find there's a bit of a gap between different functions when they arrive to a decision. So, even though we may looking at sort of the data mill, maybe it's a one source, but because they go through a different process, and then for compliance or financial crime, they have a certain tools or certain information that risk may not have, or vice versa. So the technology, the technology that allow the connectivity between the different functions. So for example, FCC, compliance, and risk. I think going forward, this is an area of focus for me in particular is how do we actually connect and to all the tools that are available so that all these tools are available to everyone within the functions and even the business, because I do see some of the decisions that are made by different functions contradict each other because they are looking at the different set of data and they're deriving it to the different decisions. So I think going forward, we have not really paid that much attention about what other functions are doing, what are the sort of reports and the tools they use. But for example, FCC has got a lot of good tools to detect the early warning signs. Not necessarily just the financial crime, but a lot of the fraudulent activities. So we moved the fraud team from risk to the FCC team last year because of the reason, because they got a lot of tools that we can use. So I think that the interconnectivity of the technology and the data and the analytics tools between different functions and even the business, I think we need to do a better job going forward. And I worked for many different banks, and this is not unique to Standard Chartered. This is probably the truth for most of the banks out there. But I'll finish it there. But I think this is the one that I see. It became very obvious, under COVID-19.
Sure. Okay. Thanks. We're sort of slowly running out of time, so I'll ask one audience question, which is related to COVID-19 and the current situation, and I'll go back on to another technology question. But I guess either Darren or Nick could answer this, but I'll go to Nick for this one. So the question is there, with all this sort of focus on working at home, and there's been a lot of sort of talk about the older generation needing to learn new technologies, but this question is about the sort of younger generation. If they're sort of coming to start work at an organization with all this sort of focus on work from home and technology, are they going to miss out on the nuances that they may otherwise have gained by working side by side with more experienced colleagues? I'll ask Nick that one.
Yeah, no, great question. And that's actually something that our bank at the senior most level, the CEO on down, has been thinking about what the future of work means, right? Because I think if you have a lot of people working from home, probably will become for the near term a sort of permanent feature, at least part-time for them working. But some people say, why can't we work from home all the time, right? We've performed this function remote from working from home during COVID. It's worked perfectly. Why can't we continue? And look, that's fine as showing that we can continue to operate the bank. But to the question posed, what do you lose from a values perspective by having people not connected physically in the office and learning things that they would have learned on the job intuitively? So I think it's a fantastic question and something that we are putting as a priority to say, look, having everyone work from home is not the right answer permanently. It's going to have to be a mixture because we need to have that interaction. We need to have the sustainable culture within the bank, the learning culture. And for a lot of us, that learning culture is best performed when we're in the office together and we're performing tasks together. So it will be a mixture. And I think that's the way we're trying to mitigate the loss of that younger generation learning from more experienced staff members. So that's in my view, probably the best answer we have at the moment to make sure that we keep that intact.
Okay, and we're coming to the end of this, so I'll turn to Lewis now to get your thoughts on the technology piece. And obviously, as we said at the beginning, you're not working in a particular bank. But how do you see the sort of technology landscape evolving because of everything that's going on, because of the sort of US-China trade tensions, because of COVID? Do you see that changing at all?
Well, we look at these issues from the economic perspective. What would those types of scenarios, risks, what would they mean for the global economy? And so if you think about the current efforts by the US government to decouple the US economy from China's economy, and to ideally, from their point of view, build an alliance where other countries join them, decoupling from China. Of course, that has, especially in that technology sphere, major implications for, it has very direct implications in terms of we are going to have, you know, the kind of app that you use and communicate with, what it is will depend on where you live, and it will hamper international communication and interaction. It also clearly has deeper or like more fundamental economic issues, in the sense that the more that we split up the world, the less cross-fertilization there will be, the slower that technological progress will proceed. So that is definitely an issue. And of course, there is a second element or a second dimension to this, and that is all this talk about firms having to split their supply chains, that many firms had been putting all their eggs in one basket to build a super efficient, internationally integrated supply chain. And now the pressure, or I would call it pressure, is for these supply chains to become simpler and to not put all your eggs in one basket. Many firms talk about a China plus one strategy. I read an FT article, which I personally think is wrong, but it was out there anyway, that talked about firms will have one supply chain for China and another for the rest of the world. I think it's not that simple. I think we may end up with having one supply chain for the US and one for the rest of the world. But clearly these are the discussions that are taking place on to what extent are these supply chains that have become very efficient, to what extent are they becoming increasingly fragmented and therefore inefficient?
Okay, thank you, Lewis. I'm afraid that's all the time we have for this discussion. For those of you with questions we haven't addressed, we will endeavour to address them in writing. So this is the last session of day one at Risk Hong Kong. I would like to invite you to tune in for the day two tomorrow, which brings another series of engaging sessions to you. All that remains for me to do is to thank our panelists, Darren, Nick, and Lewis, and to all of you for listening. Thank you.
Thank you.